Hello, class. Welcome to Chapter 5, Lecture Video 2. In our last video, we talked about some receivables, different types of receivables, how to account for sales discounts and sales returns and allowances. And then we started talking at the end of that video about bad debt and how we can estimate bad debt expense. When we finished up, we were doing the credit of percent of sales method to estimate our bad debt expense. Okay. Today, we're going to get going here. And we are going to start with a different method. So let me get my screen shared. So instead of doing a percentage of sales method, another common way to estimate how much we are going to not collect from our customers is called the aging method. So the aging method, what we're basically doing is we're making a chart and we're saying, okay, people that are due with 0 and 15 days, okay, how is their account in that range? Is it just 0 to 15 days old? Okay, when it's in that range, we're going to collect probably 90% of that. Okay, if it was 16 to 30 days old, well, our chances of collecting that are going down now because they didn't pay within that discount period, maybe. Okay, so now we're taking it down a little bit. I do not know what this big black thing that just came across my screen is. And boy, is that annoying. Well, that made it go away with the escape key. Anyway, so, okay, so every 16 to 30 days, maybe, maybe now we expect we're only going to collect maybe about 60% of this. And then you get to 31 to 60 days, it's getting 2 months out. Now it's past the next due date. Okay, well, maybe we're only going to collect 50% of this. And then if it's over 60 days, maybe we're only going to collect, 20% of this. There it is, but you're going to have a different percent for each category. It's going to be based off of your allowance for doubtful accounts. It's not going to be based off the receivables. Okay, so we're going to look at our allowance for doubtful accounts. We're going to look at our total sales out there. Use our total receivable, our aging schedule from our receivables. And then we're going to get a total amount that we expect that we can't collect. And we're going to make that the ending balance of our allowance for doubtful accounts. Okay, instead of that being the journal entry, that's just going to be a starting point for us on this one. Okay, so here is our current situation in an example to hopefully make this make more sense. We have accounts receivable of 2,240, allowance of doubtful accounts for 6,700, credit balance. Okay, during the year we had this much $3,100,000 in credit sales, collected $3,050,000 accounts receivable, and wrote off $60,000 of accounts receivable as uncollected. So what is our pre-adjustment balance in accounts receivable for December 31st? Okay, so we had a beginning balance, 224. The sales went up by $3,100,000. When we collected some, we made a credit journal entry, so it went down. And then the write-off, okay, when it happens, it actually makes our receivable go down. So our pre-adjustment value here, we have $249,000 in our accounts receivable at the end of the year. 2, what is the balance in our allowance for doubtful accounts? Okay, well, it had a $6,700 beginning credit balance that was given to us. When the write-off happened, we would have journal entered that with a debit to our allowance for doubtful accounts and our credit to accounts receivable. So we saw the 60,000 lowering the receivable in the last slide. This slide shows you the debit entry that would have been made for the allowance for doubtful accounts, creating a $53,300 balance, debit balance in our allowance for doubtful accounts. Okay, the aging method is a balance sheet and estimates. So Did it give us that information? Okay, so that was 1 and 2. First thing we need to do is find our balance in accounts receivable and find our balance in the allowance for doubtful accounts with the information given. All right, so they do an analysis and they find that 7,200 of the current accounts receivable is uncollectible. What is our adjusting entry here? Okay, so when they found by using the aging method, $7,200 is uncollectible, that then becomes, as we see down here, our ending balance in the allowance for doubtful accounts. So we calculated here that our pre-adjustment balance was 53,300 debit. We need to have a 7,200 credit ending balance. So in order to get that, we need to make a credit entry to this account for allowance for doubtful accounts for 60,500. When we make that journal entry, it is paired with bad debt expense based off our estimate. So we would debit our bad debt expense by 60,500 and credit our allowance for doubtful accounts. The main difference here is that between this and the percentage of sales method is when you do the percentage of sales method, what you calculate is the number that you do in your journal entry. Okay, when you do the aging method, the number you find is your ending ADA account balance. Okay, so then you got to go one more step to actually figure out what your journal entry is. Okay, so for allowance for doubtful accounts has a 4,500 credit. On the aging, we estimate 35,000 of accounts will be receivable, of the accounts receivable will be uncollectible, which will be the amount of the account's expense. So we have 4,500 credit. We need 3,500 credit at the end. So in order to make that happen, we only need to make a journal entry of 35 or 34,500. Oh, that was just horrible math on my part. 30,500. Yeah. The 3,500 minus the 4,500. Right. So yes. Percentage of credit sales is better for our income statement. The aging method, and it can analyze the accounts receivable, and it's more getting our balance sheet. Okay, being correct. Either way of these, either one of those methods are okay under GAAP. The problem, in my opinion, with the percentage of sales method is you're always estimating at 3%, and maybe 1 month only 2% do not pay. You're not making any kind of an adjustment for that. Okay, you still took out 3%, you're just leaving it 3%. You're taking 3% out again the next month. And you're constantly higher. When you're using the aging method, you're actually analyzing all of your receivables. So I think it gives you a more accurate representation of what your bad debt expense really is. May not be exactly right in the period, because this allows for a little fluctuation here. As you can see, there was a $60,000 expense in our example there, and that didn't happen unless they would have wrote off that $60,000 the year before. So actually that 60,000 was underestimated, and they didn't expect that. Okay, so there's good things and bad things about both of them. They are both allowable under GAAP, and you need to know how to do both methods for your homework and for the exam. Okay, one thing I want to mention is sometimes companies can get bogged down in receivables, making a lot of sales, getting a lot of receivables, but they just might need some cash. And maybe payroll's coming due and they got to pay, or they got some kind of big supplier or a bond issuance that's coming in and they need cash in order to make these payments. They have for receivables. They might go through a process that is called factoring their receivables. Okay, that is when they sell their receivables to someone else to collect. You have a fee, so it's going to become a loss. Okay. Usually it says here, like it says here, 1 to 3% fee. And then somebody else will then be in charge of collecting the receivables instead of you. Okay. So it is a way for business to get cash. You don't need to know a lot about the accounting on them. That's more of an intermediate topic. If you go on in accounting, you'll learn all about that in your intermediate accounting classes. Next, bank cards, credit cards, and debit cards. Okay, they're going to get treated as cash. And because you remember when we talked in chapter 4, cash equivalents, or anything that expects to be converted to cash within 90 days. So if somebody comes in your store and they buy someone's credit card, you can bet you're going to get that payment from the credit card company or the electronic funds transfer from the bank, if it's a debit card, within those 90 days. So we just record everything as cash. The only thing is with these is credit cards will charge a fee. Okay, it's paid by the supplier, not by the customer, although it has become more common now for some places to tell you, this is your fee. If you're going to use a credit or a debit card, it's going to be an extra 3%. Think of your Department of Revenue as one example that does that, is because they are passing that credit card fee onto their customers. Okay, but the credit card companies are actually charging the business a percentage of fees that come in. Okay, you may think, why would anybody want to do that? Okay, well, it's convenience. Everybody has debit, credit cards. You'd be losing sales if you didn't do it. Even though you might have to pay, a business might have to pay those small fees off. They're increasing sales by having the convenience of cards, and it keeps great records for you. Okay, stuff like that. You kind of have to, if you want to be competitive, you're going to have to accept debit and credit cards. So the credit card company is charging you 2-3% fee. You can either jack up your prices by 2%. You can straight up tell your customers when they get to the register that you're going to add 2%, or you can just bite the bullet and take that expense onto your business yourself. Get debit cards. Sometimes get debit cards don't have these fees, but again, they're treated just like cash throughout the process. Okay. Note receivable. Note receivable is when someone signs a formal agreement to pay you back, so pay you sometime in the future for what they bought. Think about when you take out a loan. Okay, or maybe you bought a car from the car company and they directly financed you. They're selling you a car, you're right, and they note receivable. Okay. The amount of the selling price or the amount that's lent is going to be called our principal. Okay. Everything that gets paid back, and that's what the note receivable is always going to be recorded at its principal amount. So the note receivable is always at the principal. Anything that's received over that is interest. Usually going to be at a specific rate. Okay, and then we have our maturity date. That's when it has to be paid back, when all principal and interest must be repaid on that date. Okay, and remember, notes receivable can be current or they can be long-term receivables. Do we expect people to pay us within a year? It's current. Okay, we could do a 9-month note receivable. Okay, and we sold somebody a lawnmower for $5,000 and they put $2,000 down and said, I'll give you the rest within 90 days. Okay, we signed a note, paying a little bit of interest on that. That is a note receivable. Okay, when we go to calculate how much interest we're going to get, you're going to need to remember this formula. We're going to use it in the receivables. We're going to use it in the payables. We're even going to use it when we get into the long-term liabilities. Okay, so whenever we go to calculate interest, interest is always listed at its APR, or its annual percentage rate. Okay, so if we want to find out interest on a 3-month note or a 6-month, 9-month note, or even how much we're going to get over the length of a 3-year note, we need to know that the interest is listed annually. So to find that interest amount, it is our principal, down here on the bottom, times our rate, which is an APR, multiplied by the number of months divided by 12. So if it was a 3-month note, it would be multiplied by 3/12. If it was a 6-month note, it would be multiplied by 6/12 over 1/2. Okay, and that equals our interest. So Dover Electric Company purchased on account $50,000 of consulting services. The amount due is full on January 1st, 2044. They cannot pay by that date and negotiate an extension with a 10% note instead of the unpaid accounts receivable. All right, so when we did the sale on 23rd for $50,000, we recorded the revenue. Services were performed, so we recorded the revenue. And we created an accounts receivable because they owed us $50,000. Next year, or on January, not next year, so what, in 2 months, when that became due, we're like, man, we can't pay you right now. So what we did is we worked out a deal with them. We turned it into a note receivable. So we said, okay, we're gonna give you extension, we're gonna allow you to pay further, but now we want it formal, we want it in writing, and we want to add some interest onto it because we're not getting a timely payment. So we created a notes receivable now. They owe us $50,000, and we're going to credit our accounts receivable because they no longer owe us on that account. That's what we created up here at the top. We need to make that go away. Since we did this on December, we did this when? Let me go back to my example here. So we did this all on January 1st. Now, 2, how much interest will we be paid if they repay it on July 1st, December 31st, or March 31st, okay? So we have interest here, so it could either be what? They paid on July 1st, that's a 6-month note. December 31st, that's a 1-year note. Or March 31st, that is a 15-month note. So we have a current liability, another current liability within a year, and then this one would be kind of split up, okay? But it's classified as long-term because. Right, so. July 1st, how much interest would they earn? 50,000 times the 10% annually times 6/12, 2,500. If it was a year, they would have all of it. They would get 5,000 in interest, 50,000 times the 10%. And here it's 15 months, so it's 6,250. Number 4. So assuming that we're going to pay on March 31st, 2025. At December 31st, okay, we have earned $5,000 worth of revenue. That's what we calculated here in B. So we would need to record interest income of $5,000. If they paid us that day, we would get cash, of course. But in this example, it's saying, what if they didn't pay? What if the deal was not set up until C? Okay, so here we would have interest receivable. Then when they actually came and paid in C, okay, they would pay us cash of $6,250. We could take our receivable of $5,000 off, and then we still have $1,250 of the interest that was earned in this next period that we would credit as our interest income. Okay, and here is how, well, actually, here it is right here. So on our payment dates, okay, the journal entries for each of those. You see if they paid in 6 months, we're going to get cash back of $52,500. 50,000 of it was the notes receivable, okay, taking the principal off the books. The rest was interest income. Same thing if they paid on the 31st. We're going to take off our notes receivable because they paid the whole principal amount, plus they paid the interest, then we can now record our interest income. This one is different because we have recorded interest income on December 31st because we have to get that income in the right period for the matching principal of 5,000. So when they go to pay us back, they pay us $56.20. That is the principal 50,000 plus the accrued revenue that we had there. Okay. And then the revenue that was earned this period. All right, internal control, make sure you're using source documents. You can look through these slides if you want. And then kind of our summary, what we need to remember from this chapter is how to record the amounts of receivables with the sales discounts and the allowances, how to calculate bad debt expense using the percentage of sales method and the aging method, and being able, what was the last thing we did here? Oh, being able to account for notes receivable and the interest that is earned off of them. Okay, that is it for chapter 5. Please try the handout problems on your own before you watch the videos, which I'll have up for you here. And as always, best of luck. If you have any questions, do not hesitate to reach out to me. I'm your